Welcome, everybody, to our monthly podcast. Today, I'm joined by Phil. And Phil, welcome to the podcast.
Hey, thanks for having me.
Now, Phil, could you just start by telling us a little bit about yourself, what you do? That would be great.
Cool. Yeah. So my name's Phil Thompson. I run a business called Skywell. So what we do, we're financial advisors, and we just specialize in insurance only advice. So personal insurance. So we'll get into detail about what that is, how that works. So yeah, we're financial advisors. If people need holistic advice or advice on super investments, then we're not the right fit. But if people are wanting to just sort out their insurance, making sure that they're covered or their families are covered, that's where we step in and help out.
Awesome. So, okay, let's talk about life insurance. So, briefly, what are we actually talking about when we say life insurance, and how is that different from private health cover?
Yeah, so I mean, the term insurance kind of encompasses anything. You can get insurance for your iPhone, and you can get life insurance, and they're very different. So we work in the life insurance space. So the main products for that is life insurance, so death cover. If you pass away, there's money that gets paid out to your dependents or whoever you nominate. The next one is disability or total permanent disability, TPD, and that's if you're totally and permanently disabled and you're unable to ever return to work again. Next one is income protection, or sometimes called salary continuance, and that just pays you a monthly benefit if you can't work. And then there's trauma insurance, so that's for specific medical events, things like cancers, heart attacks, strokes. You can get paid out. And then there's also child's cover. So if something happens to your child and they're ill, excuse me, and if they're ill, there's a lump sum payment there. Now, how that differs to private health insurance. Private health insurance is if you incur a bill for hospital, then your private health insurance can cover that. The life insurance under the umbrella of life insurance, that covers you individually if you can't work or you're injured or you pass away.
Yeah, great. So, there is a couple of different types of cover that sit within that term that we all sort of use as the overarching term life insurance. So thanks for spelling that out for everyone. I think when we think about life insurance, we'll talk about it as an umbrella term. The typical triggers for life insurance or getting it, or when it kind of becomes something that people think through, or do I need this or not, or what? The typical triggers are things like taking on a mortgage or having a family and then some kids or some dependents. So what are, do young people without a mortgage, let's say, and without any dependents, do they really need life insurance?
Yeah,
Young.
it's a good question. Yeah, I mean, life insurance, if I don't have dependents or I don't have a family or a mortgage, do I really need money paid out if I pass away? And it's a great question. And that's why when we talk about life insurance, it encompasses those other policies. So life insurance is just one policy that protects if you pass away. So something like income protection is really important, especially for young people. Once you've got an income and you're reliant on that income, it's really important to protect that. So, I mean, insurance is a really interesting thing. It's always a balance between how likely is this going to happen for me to get paid out, like iPhone insurance or phone insurance. If I crack my screen, maybe I do that once a year or, every second year. But then there's also the financial impact of it. So, if the financial impact of replacing the screen is $200 and I've got that sitting in a bank account ready to go, then do I need insurance on that? The thing about like income protection, I just did the math before for a 25-year-old earning 85 grand a year, their lifetime value of that income, assuming no promotions or income growth over and above, just inflation, works out to be like $8.4 million in total of that, ability to earn an income. So again, it's about this. How likely is it to happen? It is less likely to happen statistically when you're young, you're healthy. But then also, what's the financial impact? It can be, astronomical, $8.4 million for that financial impact if you could never return to work again.
Yeah, that's a really good point. I think sometimes people, especially young, when we're young, we think we're bulletproof, the world's our oyster. We're really only thinking about the opportunities that lie ahead of us or
Mm.
the, the the upward trajectory of our life and where we might go from here. We don't necessarily have room or space for, or even like a reference point in most cases for what would happen if I couldn't work. So you've gained us a really great statistic there. Well, a number, I guess, or a calculation, $8.5 million. That's a huge lifetime income. Um, what do you say when people say, well, you know, yes, but there's workers' compensation for that, or there's, mum and dad for that, or there's, is that something, is there validity in that argument, or is there more things to consider in why those potentially aren't lifelines, if you like?
Yeah, so I mean, for us at the end of the day, like we talk to adults and we treat our clients like adults. Like, so if people want to self-insure or have a different philosophy, that's okay. Like we're okay with that. My view is I've had my parents living with me as an adult, and that's not a fun experience. And if I had to return to live with them, that's also not a fun experience. So the if you're injured for 3 months, 6 months, yes, you can maybe, ask for support and that's, statistically more likely to happen. You're only injured for a short period of time. But if you could never work again, which is the absolute worst case scenario, then that backstop of, well, I'll go to the parents, then that can be really difficult. I know I never want to move back with my parents. And so I think about that. Also the thing about like workers, compensation, that only kicks in if you're injured at work. So for me, I'm an office worker. Like I sit here at the desk all day long. Like the likelihood of me injuring myself is more outside of work when I'm, wrestling with my kids or, just being an idiot, doing the everyday normal thing. Um, Sitting at a desk, unless it's like a chronic back injury, that's really the only likelihood of it happening, or RSI from writing.
Yeah.
So that's where work cover can kick in, but it's only for work-based injuries. And there were some statistics recently. I don't have the exact numbers because I didn't know we were going to touch on this exactly, but out of the potential claims, I think less than like 40 or 30% of people actually claim on the work cover,
Yeah.
and that's on all potential claims as well.
Yeah, that's right. And so it covers different things, like it's gated in terms of when it's can be even relied on, right? Like you said, it's
Correct.
only if something happens at work. Um,
And
and
income protection covers you if you cannot return to work for really any reason. It doesn't matter how you got injured, whether you're on holidays overseas or however the injury happened. There's no requirements or rules to prove that it was a certain thing. I just can't go to work, and then you can get claim on that cover.
and how long can that cover be? How long can that cover provide cover for in the event of a claim nowadays?
Yeah, so income protections, so the other covers I touched on, life, TBD, trauma, they're all lump sum payments. If you claim on it, you just get paid out, a massive check for whatever you covered for. Income protection is a little bit more nuanced, whereby you need to wait a certain period before your claim will begin. So most of them are either 30 days or 90 days. So I get injured today, and if I still can't work after 30 days, then I start getting paid my monthly payment, or I'm eligible to claim on it.
Yeah.
So it's kind of like an excess for income protection. If I do a 90-day waiting period, then it's even longer. I've got to be off work for 90 days plus before I'm eligible. And then the other major thing is like, how long is the benefit period? So it's really only three numbers. So it either lasts for 2 years, 5 years, or till age 65. So what that means is if I'm on claim and I can't work, and my benefit period is 2 years, I'll get paid every single month after that waiting period for 2 years, and then it'll stop. If I can't go back to work, well, my insurance cover doesn't pay out anymore. The other option is 5 years, again, the same thing, or till age 65, I can get paid every single month, as long as I'm injured and I can't return to work, every single month until age 65.
Okay. So there's definitely there's a lot of benefit really there. I mean, some people like to insure for everything they can, they're sort of a risk averse. But even if you say you're someone who's got a different philosophy and a little bit, more akin to taking on more risks, or looking at what the argument for is or against, you jump to the worst case scenario and then you work backwards from there and say, well, what are the other things that I have available to me? Workers' compensation, family and friends, etc. You can kind of exhaust that list of opportunity things you can rely on. Then it's really, am I willing to self-insure or not?
Mm.
Um, and can I ask you, we talked about when you're young and you're just starting out at work. There's lots of big life decisions to make. Typically, there's what career am I going to choose? Where am I going to live? I think they might be thinking about other financial things like should I buy a property or maybe a car? Or they might be dealing with financial decisions around cohabitating. Is there a good argument for adding life insurance to the mix of you know, things that they should consider at this stage of their lives?
Yeah.
What's the core argument for taking out cover early as opposed to later in life when typically most people might because they got married, had children, or took on a
Yeah.
mortgage?
Yeah, I mean, so there's a few kind of clear advantages of getting it young. So one of the things about like life insurance under that umbrella is that at the time you apply for the cover, the insurance company will make an assessment on your health as to whether they're going to cover you and how they're going to cover you. So there are some pretty common exclusions. So what that means is if I've got a pre-existing health concern, like I've hurt my back quite a lot, and I'm a desk I'm an office worker, and then I apply for cover, the insurance company are less likely to offer me cover for my back. So they're going to put an exclusion on the back. So in the future, they'll cover everything else except any back injuries. And generally speaking, the younger you are, the less kind of niggles and pains you have. And so the broader coverage that you'll get. So if you get it when you're older, post kids, post, mortgage, you may have some more health issues that are now excluded from the cover. So that's one of the big arguments for getting it younger while you can. And again, just going back to that, the maths of it all. If I'm 55 and I've got 10 years until retirement, I've probably saved up some super. I've probably potentially got some investments, and so maybe I can self insure then. But when I'm young, my lifetime income is significant. Like I can't go and buy that house if I don't have an income. I can't go and build wealth if we don't have that income. And so it's kind of really, in my view, it's just as important as any other cover. And in fact, it's more important than any other insurance cover. I mean, I'm clearly biased. This is what we do. This is what we're passionate about. But like, if you got car insurance and your car's worth 10 grand, don't spend $1,500 on that a year. Then you may as well use those funds towards income protection if you're covering what $8.5 million in terms of lifetime, income.
Yeah, I think that's such a valid point because we often think, oh, we do it when we're older because we can afford to pay for the premium better then. Um, but like you just said, there's every chance that when we're at the end of our working life or toward the end of our working life, we've got more capital and asset base to self-insure to a certain
Mm.
extent. Whereas, yeah, if something was to happen at the beginning of your life that yeah, and it might not even be, I think everybody has the, if I get hit by a bus, but what are the chances of that? It might be something that just reduces your income earning capacity by, say, I don't know, 30 or 40, 20, 30, 40%, and you can only work part-time. So initially you might think, well, I could still work, but maybe that affects your career growth or your career progression and therefore that ultimate, earning
Yeah,
capacity.
correct. And I mean, these things happen to young people as well. Like our average client age is like 35. Our average claim age is 32 and a half. Like, so,
Mm.
we've got some like, and they're not just like mild claims like I hurt my knee, so I'm off work for 2 months. They're like, we've got two clients who had MS. And so that's a lifelong disease that is going to potentially progressively get worse. We had a client with pancreatic cancer, 42, two young kids, and they've got debt, they've got kids, and so they're in that stage where they're more
Yeah.
likely to get cover. But we had a client with breast cancer, who, pre-kids, pre-debt, and got cover in place, and she had breast cancer at 31. I think she was 31 at the time. another client who had long COVID, still on claim on income protection, and she can work some hours, and the insurance company are paying the gap between what she's able to work and what she would have if she was able to work full time. So income protection, it's not just it can make up the difference. As you said, if I was earning 100% of my income, but an event meant that I can only work 40%, well, the
Mhm.
insurance company can cover that gap as well. So there are lots of policies that do partial payments.
Yeah.
And to touch on your point again on like affordability, one of the things that I think a lot of young people probably, and that's why I'm waffle on about insurance all the time, is because insurance can be funded a lot through your superannuation as well. There's significant amount of cover that you can get through your super, either set up directly to your super fund or through a financial advisor, and they can set up with your super fund. And so it doesn't need to be a do we save for our house deposit or do we get income protection? Because you can fund a lot of that using your super money.
Yeah. Okay. That's a really good point. I want to come back to the super thing, but just before we move on to that, I just want to ask you briefly about those examples that you gave with the lady that had breast cancer. So what kind of, I think people think, yeah, but they probably have no concept really about how much of an impact having a policy can have depending on, what are the sums insured and how does one work out what they have as a sum insured. So um, when you have, like, for example, with that trauma claim, what are the kinds of sums insured that these people are insured for, and what difference does it make in your experience to their life? Does it mean paying off debt? Does it mean funding lifestyle choices because of what's happened to them? What's the
Yeah.
upside?
And yeah, so I mean the good thing about insurance, it's not a I take out $1 million or I don't have any.
Mhm.
You can kind of tailor it towards your budget. So we at Sky, we've got a philosophy around the level of cover that we recommend clients take out, and a big part of that is making sure we're replacing income for us for the time of which is reasonable for a certain event, and then pay for some medical costs. So excuse me.
Mhm.
So for this client with breast cancer, she had 6 months worth of income protection payment paid out, and she had a trauma policy. Now, we set her up with $129,000 worth of trauma cover. That was our methodology and how we got there. And she was originally from New Zealand and was living here and working as a radiologist. So when she had breast cancer, she didn't have family around her. So she was able to, fund her parents to come over and be with her for that period of time for a few months. And it allowed her to not just get her parents living with her and living on top of each other, like, she could fund an Airbnb nearby so her parents could support her, but not be living on top of each other. I mean, there's numerous examples of these, impacts. Like I was actually just talking to an advisor friend who runs a podcast where she interviewed someone who was a quadriplegic, 20-year-old, went to Bali with her mum, wasn't drunk, just dove into a pool and now a quadriplegic. And we were just talking about, the difficulties and whatever. And she was saying that, she spends $83,000 on going to the bathroom every year. And like they're just things I don't even think about.
No.
One of the insurance companies does like a cost of care, like the average cost. And that's a really good kind of grounding. And we do a lot of our kind of analysis using a lot of that data.
Yeah.
And a quadriplegic is, the average lifetime cost is $11.3 million, which is just insane. You can never have enough insurance to cover that. And
Yeah.
we never recommend anywhere near that. But it's just striking that balance between how much of these premiums going to cost and, how much cover do you want?
Yeah. It's about, I mean, that's right. You can never think through every entire scenario or every worst case, you know, possibility, but there is a lot of validity just seeing, for example, some of the opportunities and the choices it affords people who do have cover to get back on their feet and to cover the expenses associated with it. And I think it would be your experience in dealing with your clients that it also it's got to have some kind, mental health benefits too, like
Mm.
assisting with dealing with those scenarios. Like we know that, people who are from some research just recently put out by ASI can be off blow that people who are dealing with financial challenges are twice as likely to suffer a mental health event and vice versa. So you put someone in a stressful situation where they're dealing with a medical event that's having a huge immediate financial implication. And also as the dust starts to settle, so to speak, ongoing financial implication that's got to have a
Yeah.
lot of, impact on their mental health too.
Yeah, for sure. Like that's kind of one of the biggest benefits of
Yeah.
insurance is when you're dealing with these really stressful, difficult, medical issues, to then have uncertainty around money and how you're going to afford it. Like, one of my really good friends and a client of ours just had pancreatic cancer. He called me up at the start of the year saying, "Hey, I've got cancer," and so his wife is currently not working, looking after the kids, and he's lost his not lost his job, but he's no longer working because he's got to go through chemo, and he's gone through 6 rounds of chemo, and he thinks there may be another 3 months left. And just having the money in the bank, it means that they're not worrying about that long term impact. He's thinking now, well, maybe I'll go back 2 days a week when I'm after chemo, and because I know income protection will pay the gap as well. So he
Yeah.
can really think about not just rushing back to work, paying the bills. He can kind of do it when he's ready, when his body's ready, when his mind's ready to get back, at a more, full time capacity or whatever capacity he can get to.
Yeah. And so if we want to talk about like, being intentional with insurance, and so say this is something that someone is looking into or wanting to consider, is there, how big of an impact or influence is career choice on the insurance question or life insurance specifically? So what I mean by that is, are people who work in certain professions, is life insurance more aligned to what they do, or is it more necessary, or are there more advantages or discounts or sort of things for people in different careers?
Yeah, so I mean, occupation has a really big impact on some of the cover. So because it's income protection is the big one. Another one is total permanent disability. That's all based on your ability to return to work. So someone like a builder or carpenter, their premiums are much higher because their ability. It's not the risk at work. I mean, that's priced in a little bit, but it's mainly priced in your ability to return to work. For me, if I'm in a wheelchair, I'm going back to work. There's no issues. I can roll into my office and happy days. But if you're a carpenter, you're never able to work again. So the claims experience will be very different. The carpenter will get paid out every single month until age 65, while me, I won't even go on claim potentially. Obviously, depending on how it results to and how we get there. But I can wheel into my office. And so that does have an impact on pricing. So, what's deemed higher risk occupations will be priced more. And then, therefore, office based environments, professionals, white collar professionals are generally cheaper to get cover for. So, occupation does have a big impact on pricing and the way insurers view it because it has a big impact on claims.
Yeah, that makes sense. And are there any discounts for people in certain professions? Like, do they even incentivize people who are young working in white collar professions to get insurance early, or no?
I mean, and the other benefit with young people getting covered, there are ways in which you can pay your premium. So, some insurers will offer what's called step, so it's cheaper today, and then every year you get older, it's more expensive. So, if you took it out today, it's priced at your age today. If you waited until you're 40, it's the same price as if you got it today. It just goes up. But level premiums is much higher today, but it doesn't increase just because you're getting older. So generally for our clients, if they're setting up cover really young, we'll consider level because the lifetime cost of that cover may be much more affordable. But if you set it up older, well, we look at that pricing that's age based every year. So there are some benefits of getting it done younger for sure. But in terms of discounting, not really. It's generally like occupational discounting. most insurers will just have their preferred, like, occupations. There is one insurer on the market, only one, who they will only offer cover for 24 occupations. And if you're within those 24 occupations, which financial advisor isn't, then it can be priced really well. And because they basically mitigate their risk and potential claims because they're only covering those occupations.
Okay, great. So I want to talk to you just a little bit about, get you to share your thoughts on, you mentioned briefly before that, if someone's considering, well, taking out insurance, but feeling like the opportunity cost of paying a premium on a life insurance policy or an income protection policy is, I'm losing that cash flow that I'm saved, trying to save for a house, trying to save for like wealth creation. I want to get investing, all that kind of thing. You mentioned structuring it inside super is is a way to go. So can you talk, I mean, that's done through advised policies. Am I right? Like, so dealing with an advisor like yourself, what about, can I just want to caution as well, there is a difference between life insurance or tailored life insurance through superannuation and what we call default cover through super. Can you just
Yeah.
explain the differences for us?
Yes. So, I'll just touch on kind of the differences between the covers. So you can get covered directly to your super fund. So whoever your super fund is today, you can go to them. Almost all of them have a contract with a one particular insurer, and that's like kind of called group cover. And so you can apply for either like when you set up the super fund, you'll get the default level of cover, generally 150,000 of life and TBD. It's generally really small amounts, and a really cheap cost for the default cover. But then you can go to the super fund and say, "Hey, I want $1 million, let's say, or $500,000," and they will price that accordingly. And then you've got to go through what's called underwriting, so you can get more cover directly with your super fund. Now, the downsides of that is it's a one super fund. So your super fund has a contract with one insurance company. So if they're really expensive, too bad, so sad. You've got to go with that insurer. There's no options when you're going direct to your super fund. The other option is going through a financial advisor. So like what we do, and what we can do is we can partner you with the right insurance product and insurance company that's best suited for you based on your health history and based on your occupation, and we can set it up so that insurance company will deduct the premiums from your super fund. So they don't need to be directly connected, but that can only happen if you're set up through a financial advisor
Yeah. So
where
you
you
don't,
have, sorry, go.
I was just going to say, so you don't have to have your super fund balance with the same insurer.
Correct. Yeah. So basically what it does is, technically speaking, the insurance company, they set up a pseudo super fund on your behalf.
Yeah.
They don't manage your money. They won't want to manage your money, but all they do is it allows them to go to your super fund, Australian Super or whatever super fund you're with, and say, "Hey, can we transfer, the balance of the premiums over to our super fund?" And then they pay the insurance premiums every year. So it means that you kind of get the best of both worlds, where you get the right insurance that's best suited for you, and then you can move your super around. Because the other downside of going through the super fund to get your insurance is, if you then move in super and you go, "Hey, I don't want to go with Australian Super, I want to go with ABC Super Fund," then you lose that policy. You can't transfer that policy and take it with you, because Australian Super have that contract with the insurance company. So if you move away from that group, well, then you lose that policy.
And I think some people might think, well, cash flow's a little bit tight and, they may be concerned about the impact that, in this case, the premium is having on their super balance. So I mean, what would you say to someone there? Is there kind of like you know, depending on what balance you've got in super, at some point it's not a good idea versus, or should you be doing something else just to preserve your super? Like, what would you, I know we can't give advice, but I'm just saying, is that a warranted concern? And what should people generally be thinking through if that's the case?
Yeah, I mean, if we just take a step back and just go, all right, there's premiums for insurance. Do you want the insurance or not? If you do, and you got to pay a fee for that in terms of premiums, it's just a matter of how do we fund that? Do we pay it out of our bank account or do we pay it through the super fund? If we choose the super fund, it doesn't mean it will have a drag on the balance. So, at retirement, you'll have a lower balance. Now, if cash flow is tight, you're saving for a house and you want to maximize that cash flow saving, the reason why setting it up through the super fund can be really good is because year 1, 2, and 3 of the premiums, when you're saving for a house or saving for that big expense, your super balance can fund that cost. And then in year 4, 5, and 6, you can fund 200% of the premiums because you're paying back year 1, 2, and 3 into the super fund as a contribution to the super fund. So it means that your insurance bill, every year it comes, like my car insurance, every year it comes, I can't say, do I want to pay that or do I not? I've got to pay it or I don't get car insurance. With the insurance, if it's set up through the super fund, you can kind of, change it around and choose how much to pay. You can fully fund the premiums from year 1 by making a super contribution. And we're getting down in a little bit of a rabbit hole because there are a whole bunch of tax advantages of doing it and structuring it that way. But I'll try and make it simple and say one of the good thing is you can put money into super to pay for it if you want to, and it has no impact on your retirement savings, or you can keep that money in your bank account to save and then pay it back later into the super fund.
Yeah, so there's lots of options, I guess, and that's the benefit of having tailored advice when it comes to your life insurance as well. I think the other thing that I thought of initially, just when you were talking about insurance through super as well, people, assuming that they have cover and it's exactly the same as maybe tailored cover through super. If it is default cover and then you decide, well, I'll just have default cover for now and I'll get tailored cover when I feel like it's more needed, as I get older, and again going back to that justification argument. But obviously you're going through life at the same time and things happen and health changes, and when you go to make that decision because you feel it's the right time, you might be in a different health situation. And
Mm.
there is a difference in underwriting, right, between the two types of cover funded by super.
Well, yeah, with the default cover, some policies have like a blanket rule saying that they will determine if there's any pre-existing health issues at the time of claim. So when you go to claim, they'll go, all right, show us your Medicare, reports on what you went to the doctor for pre-claim, and then they determine a pre-existing condition, they won't pay out on it. So there is that risk that you're getting assessed at a potentially a more difficult, assessment in 10 years' time for something that happened beforehand. So there are some of those issues, but tailored advice and tailored cover, you get a medical assessment up front. And when I say medical assessment, it's just a phone call with the insurance company, go through yes, no questions. And so it means that as long as everything was true and correct at that point in time, at claim time, it's much easier. And there's kind of no wonder when it comes to like complaints in my world. AFCA is the complaints kind of tribunal. Most of the complaints when it comes to insurance unadvised policies because they're generally they're more difficult to claim on. It's just a bit trickier. The other thing, and again, I'm glad we've got 3.5 hours to talk about this, so thank you. But the other thing is with default cover, again, it's the contract's held between the super fund and the insurance company, and they can make changes whenever they want. They send every member an email or a letter called a significant event notice. So there's one major, like one of the biggest super funds in the country just came out on the 1st of May. They've changed their policy, so you can't get paid an income protection claim if you're considered totally and permanently disabled. So, most, advised products, you can go an income protection claim and you can get a TPD payment at the same time. So if I can never work again, I'll get a lump sum at the very beginning of being, assessed as TPD, and I'll get my monthly, 70% of my income or 75% of income. So one of the major super funds, that's how they did it. Moving forward, they've changed it and said, oh, if we give you a TBD payment or we assess you as totally and permanently disabled, your income protection stops. I don't care if you've got it until age 65, you don't get paid anymore. And they're the things that, as a member, I don't get to change. I don't get to influence. There's no kind of, oh, do you want this? No. The superannuation trustee and the insurance company just negotiate the changes.
Yeah. So you're at the behest, right, of the company, and it comes down to the fact that it's essentially a group contract, right? When you've got insurance that way,
Mm.
um, versus an
And it's
individual.
similar to like workplace cover. Some big workplaces have income protection and they offer it, and it's really good because they pay for it. Except that when the new HR manager comes in and says, "Oh, what's this massive bill for income protection that no one knows about? Let's just get rid of it." Which I spoke to a really good friend who did that a lot. They would. It's just a bill to the company, and they can change it and adjust it when they want to.
And again, if you've been relying on that and then you go to get cover independently, like 10 years later, once it's been taken away from you, you could be left in a different situation from an underwriting perspective, and
Mm,
what you can and can't be insured for eternally. Like, that everyone might exclude a lot of things for you. So
yeah.
that's really, really valid stuff for young people to think about. So, what would be your one tip for anyone who's trying to wrestle with this idea of, is cover the right for me right now? You know, what should I look at first?
I mean, like my number one tip is most people think it's like maybe crazy expensive and
Mm,
they don't necessarily have any idea. Most young people, I mean, as a part of our business, we always ask people, what did you expect?
mm,
99% of the time, everyone says, I had no idea. There's no context. Everyone gets car insurance as soon as they get a car.
yeah,
So my number one recommendation is at least investigate and make an informed decision whether you do or you don't get the cover. Um, and don't necessarily expect your super fund to have it because I mean most super funds are very low level and that's the way they're set up. And APRA, or no, sorry, ASIC, basically came out and told super funds that they need to increase the default cover because it's nowhere near enough, and it's not covering members sufficiently enough. And that's the corporate regulator basically saying, "Hey, do better."
yeah. Oh, that's great advice. Thanks, Bill. You've been so informative. Everyone's got a lot out of that. Thank you for your time.
No worries. Thanks for having me.